And we are live. Hello, everyone. My name is Marco. I am your host for today or tonight's event, and I'm in London at the moment. Today's event is the Great Energy Transition. Thanks all for joining us. I'll take 30 seconds or so just to give you time to all join, and I'll go through a little bit of housekeeping to start with. You've got two main ways to interact with us. Today, the first one is please do introduce yourself into the chat. Let us know your name and where you are dialing in from, so we know who we're talking to. The second one is the Q&A box. Please reserve the questions you want to ask for the Q&A box, and do make sure that you upvote the ones that you like. That will make it easier for us to get through them in an orderly manner as we run towards the end of the event. This is a 15 minutes conversation between Shawn and I, followed by 15 minutes dedicated to your questions. So let's get started. Very excited to have VanEck's portfolio manager, Shawn Reynolds, join me tonight. Shawn has seen it all when it comes to energy. He started from the position of geologist all the way to portfolio manager of VanEck's global resources and environmental sustainability strategies. How are you, Shawn? Thanks for joining us.
Very good. Thanks for having us.
Fantastic. Well, let's dive in. Let's get started. The energy transition landscape. There is a lot going on. It's rapidly evolving. Almost every day there are any updates. What are the key three trends that investors should be aware of?
I think there's really three key trends to follow here, and some of them are obvious and some are not so, and some of them are macro, and we can boil down a little bit. But I think really the three ones are to really think about how energy works in the macro environment that we are in, and we would believe that we are in a inflationary environment that's not going away anytime soon. So it's definitely dampening down from what we saw a year ago, and we would expect that. But we don't think that inflation is going to disappear like we did in the 2010 to 2020 period. We think it's going to be a little bit higher. We can expand on that a little bit further. The second big trend is that when you think about the energy sector, you can't think about it as the 2010 to 2020 sector. It is dramatically different. In fact, it's dramatically different from anything that I've ever seen in my entire career. And as you mentioned, I've started my career as a petroleum geologist and worked in the oil and gas industry. And it is very, very different. And we kind of expand on that a little bit more as well. The third key trend, though, is resource transition. A lot of people call it energy transition. Is of course, it's the ESG headwinds of the transition into renewable energy. But there's much more to it. It's much more complex than just we're switching from fossil fuels to renewable energy. And we actually think over the period of time here, and it could be as long as a decade, there's going to be a combination of what's happening. And when you think about energy investing, you have to think about both. And they're somewhat complementary. I mean, I was just talking to the CEO right before we got on this call, the CEO of one of the large rooftop solar installation companies here in the United States. And he was saying, if oil goes to 100 or goes to 140 or whatever, he goes, that's great news for me. And so, the idea is, there's going to be a point in time here where both kind of the traditional and the renewable or transition side of resources and energy are going to be working together at the same time.
Fantastic. That's an excellent summary. So let me know if I got it right. The three key trends to really keep an eye on are, first, inflation is not going anywhere. We need to keep it into account in fairness, for energy as for any other investment class or ways of investing our monies. The industry has changed dramatically. We are dealing is not just a little improvement or change from yesterday. We are living in a different world. We need to keep in mind that there are different rules and the environment has completely changed. And the third one is there is a lot of focus on the resource transition, but there is so much more than ESG, and especially the relationship between the traditional energies and the new forms of energy is going to transform as well. Is that correct?
Yep, absolutely correct. And I'm happy to expand on those if you want a little bit.
Exactly. That's exactly where I was going. So how should investors position themselves to benefit from these trends? Now that we are aware of what are the main the main three ones, how do we manage ourselves through those?
Well, I think it is, the first is the sentiment that goes around it. And that kind of ties into that macro inflationary position. So you need to think to yourself, where are we really with regards to inflation? And how do I respond to it? And again, I would just say that we think that's going to be much more sticky than certainly central banks think that it's going to be. And I would tell you that just about any study you want to look at with regards to the longevity and the kind of resilience of inflation, it's going to be around for a long, long time. It would be very odd if you saw 2% inflation a year from now or 18 months from now. It'd be a historical anomaly is what that would be. And it would be an anomaly by a large bit. So if if you have that in mind, then how do you position yourself? Well, we would, definitely say, well, you want to position yourself in natural resources, because natural resources, and energy is a big part of that, obviously, have traditionally always outperformed other parts of the market. So kind of from that macro perspective is like, hey, I got to look at natural resources. I need to look at energy because I think inflation is going to be with us for a period of time. And again, you can look at over 70 years, and that's been true, where natural resources have outperformed everything from bonds to equities to REITs to TIPS to just about any infrastructure, anything over time. And when most of these studies were put together, were kind of after the super cycle of 2000 to 2010, the commodity super cycle. And then we had the 2010 to 2020 period, and we didn't talk about inflation. And so when those studies came out, people like myself, a lot of us kind of thought, well, that was in the past, that was in the 70s, and that was the last decade that we had. Well, what we see now is that natural resources and energy, is doing exactly what it's supposed to do when it's supposed to do it. What historically you've seen, it's working again, and that would be the last 2 or 3 years. It's actually come through with regards to inflation is here. Oh my gosh, energy is working really well. So I would definitely say, that's the kind of the overarching thing. Where do you want to be positioned? You want to be positioned in that space. Within energy, it's some of the areas that we talked about, where the industry has changed, how much has transformed. I would say in the 2010 to 2020 period, the integrated companies, the Shells, the BPs of the world, you kind of wanted to stay away from them. You really didn't look at oil field services towards the end of that decade. Those are two spaces that look really, really attractive right now. They look really attractive from the oil field service spaces because they are expanding internationally. So if you think about, again, you go back to the super cycle, it was a real international story. Then you became a U.S. shale story. And it's about drilling rigs and fracking and all that kind of stuff. We're now moving away from that, and we're getting more towards looking at these international drilling programs and exploration programs, and who's doing that. So that's to the benefit of oil services companies, but who are their customers? It's the international integrateds. And so you're seeing them kind of also make this a little bit of a transition. They were going more green, and they've kind of pulled back a little bit, but that small pullback has been, I'm really focusing on some exploration in different parts of the world. And so those are two areas that we really, really like. And then I know it's not 100% energy, but you have to start thinking about it, that this is part of energy, is you want to look at green metals. And because green metals, you need metal to make energy in the new world, to make electricity. And so when you think about that, you really want to start thinking about, well, what are all these different metals that I need, to make renewable energy. And it's things like some things you're familiar with are copper and nickel. You're probably familiar with hearing about lithium and cobalt, but it's even things like, graphite. It's graphite is the largest component, the largest metal used in any battery, whether it's used for an EV, an electric vehicle, or a stationary storage. There's lots of opportunities, and that's definitely an area that you need to be looking at and being exposed to, in our mind.
This is great news for our audience. They're definitely in the right place tonight, Ben. If they want to protect themselves from inflation, they are looking at the right asset class. And what you were saying with regards to exploration, and then the potential yields that are to be found there for investors. Does that apply also to any specific sector or any geography where you see some companies being more active than others, or some governments being a little bit more aggressive in incentivizing investment from companies? Anything we should be really focusing on?
I think broadly speaking, with regards to international exploration, which I think you're alluding to, most of the places, the companies have been around, the industry has been around long enough that, where they have chosen to explore is a little bit kind of geopolitically more stable than, where you're getting concerned. In fact, many would tell you that, the UK, the US, like the Norwegian North Sea, these are geopolitically very difficult places to work in, because they're getting hit with windfall profit taxes and different royalty rates, stuff like that. So it's the really exciting places right now are really off of West Africa. Namibia is a new place. Off of northern Latin America, another new place is Guyana. These are really, Suriname is very new. And so these are all exciting places to look at. If you think about in Latin America, north of offshore Guyana and Suriname, those are companies like Hess, which is a American E&P company, but larger companies as well as like Shell. Shell is definitely spending a lot of money on exploration all over the world. They're also off of West Africa, say in Namibia. You've been comfortable with exploring in places off of West Africa, like Angola, Nigeria, and stuff like that for years. But these are new regions that we're talking about, and kind of the Eastern Med as well. If you get out into like towards in the Eastern Mediterranean, there's lots of stuff happening there. And you would look at somebody like Shell again.
Fantastic. Also, I can see that there is some action now in the Q&A box. Just gentle reminder to everyone, because I just want to make sure that we cover as many of your questions as possible. So start putting them in now so people can upload them, and also we can start going through them. Shawn, before we move on, you started already mentioning a few company names, and that was my next question exactly. What are the companies you're most excited about in 2023?
Yeah, I mean, we mentioned the exploration names, kind of the larger ones, but but there's also some great opportunities here in the U.S. and some of the smaller E&P companies, the exploration production companies. So those are names like Diamondback, Pioneer Natural Resources. The interesting thing, and this is part of the transformation I mentioned earlier, this grand transformation, is these companies aren't growing as fast as they did in the previous decade, but they're being much more prudent about their capital allocation. So their growth is coming down, which in normal times you would kind of think, well, that's not necessarily good, but they're growing at a reasonable rate, and they're using a lot of that capital that they've saved over the years to actually give it back to shareholders. So dividends, special dividend yields, variable dividend yields, and share buybacks are actually making your returns of on capital yields much higher than they've ever been, again, in my career. And in this sense, there are many companies, and it's not just two or three. It's a half dozen, it's a dozen that are giving you plus 10% type of total yields of dividends and share buybacks. And this makes them the highest yielding sector. The energy sector here in the United States is the highest yielding sector throughout the entire market. And that's never been the case over the last 30, 40 years.
We are definitely witnessing a big revolution, aren't we? Big changes.
Right. And then I would also
Okay.
say, just in terms of some companies, without giving specific, absolutely specific names, because these green metals companies, they're small, and I don't really want to say, oh, you should look at this one because that's the one, because there's so many of them out there. I'll mention one, but I would definitely encourage your audience to investigate and research this area and find which ones you like, which ones seem to work for you. But it is definitely an area and a space that we think is really attractive and really a place that you want to be. And I'll just mention the one which is called Allkem, which is an Australian company, and that's ALLKEM, and they just merged with a company called Livent, LIVENT, to become the third largest lithium producer in the world. And they're going to be now competing on a global scale with the other large lithium producers, Westernly listed lithium producers. And it's just really exciting to see what they're having, and they have a complete integrated kind of lithium business, which most of the others don't have.
Fantastic. So for the audience, Michelle has kindly posted the names in the chat. Do make a note of these and do keep an eye on those, because that's the beauty of our events. We really discover a lot of insights into the industries we deep dive. So it's your turn, guys. I'll kick off with a question from Tom, which relates to the green metal theme that we've been exploring so far. It's a question kind of halfway through between ethical and ESG. So how do you think the modern slavery issues with battery-focused commodities linked to mining green metals is going to mold the future of the energy transition? So Tom here puts it in a little bit of an either-or scenario. Is it the demand that's going to outweigh the morality, or will we see a prevalence of the ethical side of things over the when it comes to regulation?
I'm a little confused on the ethical side. I mean, with regards to actually doing the developing the mine.
Yeah, how difficult will it be to keep evolving with the issues in the background?
Yeah, well, here's the reality. There's not going to be an energy transition if there's not metals, and if there's not a lot of metal. And so you just have to accept that if we want to make this, to get to these net zero targets by 2050, or even partial away in 2030, 2035, we're going to have to move very, very quickly in this direction, and it's going to take a lot of metal. For example, a typical electric vehicle has 4 to 6 times more metal in it than a traditional internal combustion car. And as I was saying earlier, it has a lot of different metals, all right? It has all those things: copper, nickel, lithium, cobalt, manganese, aluminum, graphite. And as I mentioned before, graphite is huge. And so you need all of those, so you can't have a shortage of one of them. You have to have every single one of them in there, and so that's the reality. And if we're going to move that direction, we need to get very, very aggressive on expanding our mining. But he brings up a very good point, is that there's a lot of resistance against mining. There's a lot of resistance in the US, there's a lot in Europe. And you've seen where most of these mines have been built are kind of, well, really all over the world. Chile is huge in copper, Chile and Peru. You think about places like nickel. Indonesia does a great job in nickel. Russia is big in nickel. You think about cobalt, the Democratic Republic of Congo, rare earths, China. interesting thing about all of those things that I just mentioned is that's where the raw ore is produced. All right. So that's just digging it out of the ground. The really, ethical issue is where does it get processed and refined into final goods, into battery grade or renewable energy grade material. And the bottom line on that is China absolutely dominates. And to put it into context, say China has a 35% market share of nickel processing and refining. That's the smallest of all the metals that I just mentioned, 35%. Put that relative to, say, OPEC. OPEC controls, 35% of the oil in the world. So OPEC, 30 some countries, controls 35-40% of the oil. You look at China, one country controls 35% of the nickel. They control 40% of the copper. They control 70% of the cobalt. 80% of the rare earth metals in the world. 80% of the graphite. So China totally dominates. So it gets very complex and confusing when you start thinking about the concerns that people have with regards to mining and not in my backyard and whatnot. Well, the reality is it's happening. It just, you're not letting it happen in, a stable country or a stable region. And people have to come to grips with that. We're improving the atmospheric condition, the global greenhouse gas emissions and, the overall environment. But we have to give up a little bit on the ultimate mining side.
Yeah. Next up, a question from Anna. You mentioned Shell before. She's asking, are there any big oil companies worth investing in for the long term? And also we have kind of paired up a question from Karim, who's asking about graphene. Is it graphene or graphite you're asking about?
There are two different ones, yeah.
Exactly, there are two different things. Anyway, let's start with the oil.
Yeah, well, we really like Shell, because, well, one, they have a new CEO who we really like. And he has made a commitment towards a real balanced view towards traditional energy and renewable energy. And he's moved that way. I mean, so what that means is they pulled back a little bit. He's also made a huge commitment to what Shell has been known for a century, is taking care of shareholders and looking at shareholder capital returns. And so if when we look at Shell, it kind of ticks all the boxes. It's very cheap. It's not cheap for a reason, because it has a very strong balance sheet, generates a lot of cash flow. It uses that cash flow to continue to grow on both the traditional and the renewable side. So that's that's a big free cash flow yield. And then they reserve a fair bit of that to give that in terms of back to shareholders in terms of a very healthy dividend yield. So you kind of put all that together and you're like, wow, like what's not to like here with regards to Shell. Others that are somewhat similar to that, but not quite as interesting, I would say, is we like Eni, which is an Italian company. It's a national oil company. They're doing the same thing. They're probably more advanced on the exploration side than traditional side than Shell. And they're less so on the renewable energy side. They're more committed towards the exploration side, but they're also giving a very high yield. The other thing that's great about kind of on a temporal phase, a short-term outlook for Eni, is they have a big diesel exposure, and we're very big fans of diesel consumption or demand rates really cranking up here in the next over the next several years.
Excellent. So Shell and Eni, do keep an eye on those. You've touched on exploration a couple of times. Colin is asking, when do you see it slowing down?
Exploration?
Yeah.
Well, that's a really good point. I mean, I think we have a bit of a kind of a push in front of us here, because it's not any, they haven't been exploring in an exceptional way for 10 years. And now they're kind of coming back to it. So I think you're going to see a little bit of a flurry of it here over the next year or so. And I think it depends on several things. success rates, because one of the reasons they got away from it, and that's why U.S. shale took off, is the success rates are coming down so much. Now, a lot of technology has developed, and there's been innovations on exploration over that decade. So there's some improvements there. There's some new areas, like I mentioned, offshore Namibia and Guyana. So there's some new things there. But I would suggest that this is probably around for the next 2 or 3 years at least, because basically, exploration takes a long, long time. I mean, if you sit down today and start from scratch, you're probably not putting a drill in the ground until 3 or 4 or 5 years from now. And then if it's successful, you're obviously going to extend that. So I think you probably have several years ahead of you before there's any chance of it slowing down. And I think that probably relates to the oil field service thing that I said earlier. There's a lot of these oil field service companies that are actually benefiting from that. And so they have several years in front of them of kind of growing backlog of companies saying, I want to drill here. Oh, I had some success. Oh, I want to drill some more. I need some pipelines. I need pumps and whatnot. So there's some room to run for international oil field services as well.
Fantastic. Now, for the next question, I'll kind of try and group together a couple that I see here. Let's see if I make sense. There's a question about the transitions from traditional gas stations into EV charging stations, and also there is a question about hydrogen that I think we can consider as part of that as well. What kind of timeline do you think we are looking at?
Well, EV charging is happening, I think, both in Europe and in North America as we speak. In fact, it's very, very regional. In some cases, you're way behind. I would say in some cases you got you're well in excess of what you need with regards to charging. So that's a tough one. The charging economics for individual companies that's been tough. So we've kind of stayed away from that in general. Mm-hmm. The unit economics are not entirely clear, particularly here in the U.S. But that will change. Has to change, and we'll see how that evolves. With regards to hydrogen, I would tell you that hydrogen is actually, we think it is going to be a very, very large part of future energy. But it's not now. And the reason for that is it's just not economic right now. When oil prices in Europe shot up after the Russian invasion last year, I mean, all of a sudden hydrogen made sense on a natural gas basis. But now that prices have come way down, hydrogen has a long, long way to go to be competitive against natural gas. So that number is probably below $1 a kilogram, maybe $1.50, but but probably below $1 to take off. Right now, it's hard to get a real handle on what the average cost is, but probably just below $10 a kilogram for hydrogen. The reality is, I don't know anybody who is making hydrogen at a commercial scale, or anybody who's buying it at a commercial scale. So you can say there's companies out there will tell you, oh, I make it for 3 or I make it for 6, and you're just like, well, I don't know anybody who's buying that. And you're not doing it at scale. You're not doing it at a commercial scale. So, but when we first started talking about hydrogen, and this is, we started talking about hydrogen 5 years ago or 6 years ago, then it kind of became a big deal during the pandemic. But hydrogen was $30 a kilogram, 20, 15, now it's under 10. So we're getting there. And that has to do with technology, innovations, but also scale and different applications. So we really believe in hydrogen over the long term. It's really hard to find something to invest in that makes sense right this second.
Excellent. Very, very clear. This brings us to the very end of the conversation. We are at 5:30 on the dot. Time has flown. Shawn, thanks so much for very deep insights, and also, we've gone global. I would say we've touched pretty much every corner of the globe in this conversation. So thanks a lot. For the audience, as soon as I close this event, you will have a quick survey on the screen. Please do let us know what you liked and what you would like to see more of in the future. We'll be here for you. Shawn, thank you very much. It's been a pleasure.
Great. Thanks for having me. Good night.